And good morning, everyone. John Hutchinson with Jeff Wood from Traders Reserve. We are back with Wednesday's Breakfast Club here on July 9, 2025. Uh, Futures kind of not doing much this morning, slightly higher, I think.
Hey, we're up
Uh,
like quarter of a
Quarter
percent
point,
on, yeah, quarter point.
quarter to a half, somewhere in there. This despite another tariff announcement yesterday on copper, another 50%. Jeff and I were just talking about a little stock that some of you may know called Freeport McMoran, which is a stock proxy for the copper markets. Uh, Pre-market trading looks like it's up 2%, nearly 2%. But Jeff, you said this just hit your scan as a potential stock or call trade.
Yes.
So just briefly walk through that, and then we'll get over to the big, beautiful bill part.
Oh, well, I don't have a whole lot to say about that. Other than I'm working on a momentum indicator, and so that takes volume um, and rate of return, all those sorts of good things, and then and then it smooths it out using volatility measures. But anyway, the math is quite boring, and we can get into that in some other session. But either way, it came up as the number two stock on my rank out of the entire S&P 500. So there are earnings coming up on 7/23, but with the news and everything else, I was looking at a very short-term debit trade. Um, oh my gosh. Now it's just everything's not working on Thinkorswim. So I'm going to come back to that and go back to PowerPoint because I can't
Well,
seem to get.
let's roll back to your second reading of the 887 page B1 OB3, um,
Yes.
and continue on with the policy shifts that you feel will
Yeah.
have impact for traders and investors.
Yep. So let's get to it. I promise this will not be as long as the first session. It's going to be longer. No, I'm just kidding. All right. So we're going to talk about the remaining five policy shifts, but and then we're going to do a little bit of discussion about macro risks of the market being at all-time highs. We didn't really get to that on Monday, so we're going to do that today. But just as a reminder, because I've already had some emails about this, this is a macroeconomic thesis based on policy shifts. This is not day trading advice. This is not weekly option trade advice. So some people, in MTC yesterday, we traded IWM, we traded a call side, and someone said, "Hey, which is exactly what I thought was going to happen." Someone said, "Hey, I thought in your macro presentation or in your Breakfast Club presentation, you said Russell 2000 should be a benefit from all of this." So that is all true. Again, Russell 2000, I think over the next 3 years, the bill just went into law. It hasn't even been effect. I mean, it won't go into real effect until August 1st. So give it some time, but this is just a macroeconomic thesis of different policy shifts. So just want to be very, very clear about that. That doesn't mean that some of these stocks will never go down over the next month, or we wouldn't trade it going to the downside. Anyway. All right, so just as a part one recap, oil and gas gets love. Small businesses get to keep their some of their tax breaks. Green technology takes a hit. We saw that actually quite a bit across the board yesterday, which is why we were selling some call spreads on green tech yesterday in the MTC session. Detroit gets a little bit of a breather. It's not all from the one big beautiful bill, but Ford Motor Company, I think, has had an 8% run in the last 4 days. So that has been a good stock to keep on your watch list. It's very cheap stock though, but when it moves, it can really move. Anyway, defense spending goes to all new levels as well. So that's part one recap. Let's get into part two. Banking should get easier. The Consumer Financial Protection Bureau, it's a mouthful, their funding gets cut nearly in half. Always, I try not to get try not to do too many political things here, but anytime financial protection and funding gets cut in half, that always kind of scares me a little bit. I do think that some of the financial protection things that we have in place brought to us from the 2008 crisis. I think some of those are a little bit too constricting. So I'm happy to see some of this goes away, but I don't like overall seeing that Financial Protection Bureau funding is cut that much. But what that should lead to is less regulatory headaches. It should lead to easing compliance costs. And then ultimately that leads, of course, to better margins. So I would expect credit card companies like Capital One, Visa, some of those to see some relief. And then even mortgage companies, I just listed Rocket Mortgage, but there are so many others. So I would look for credit card companies and mortgage companies, anything dealing with financial regulations, anything that can help consumers along and pass money back and forth a little bit faster. Those would be the tickers that I would look at for benefiting from this. What?
That Rocket Mortgage pick is a homer pick, Jeff. That's a total homer pick.
Yeah. Wow.
Right here.
I hope so. I know they're in our backyard. So, yes. All right. And maybe it was just all the news ads that we saw because they're hosting the PGA thing, like about 10 miles from my house or something like that. So maybe it's just all the local ads I saw that got them on my mind. But anyway, Space Race 2.0, NASA and military space programs should be getting flooded with cash. There's some interesting things going on, obviously, with the relationships and the personal relationships with Elon Musk. So what I don't know yet is if we will see money being pulled out of SpaceX and into others, or if money will continue to flow into SpaceX. But either way, there is quite a bit in the bill related to military space programs. We need to be dominant, whether it's land, air, sea, all the whatever. Or in space. So Star Wars, all that sort of stuff come into play. So I look at things like Rocket Lab. Gee, I wonder why we traded that in MTC yesterday. But anyway, I look at Rocket Lab, Lockheed Martin, Northrop Grumman. Those are all companies that are or should benefit from money coming into these space programs. Now, this is a little bit more middle of America. This isn't my specialty. I'm not a commodities trader. So, I'll just kind of give you that announcement up front. But overall, one of the things that the president has said was that he wanted to support those in middle America, those who helped support him getting to the presidency. So farmers win big in this one. There should be now lower or price levels to support corn, wheat, soy, and cotton. Those should all get now guaranteed pricing. So that puts more money in farmers' pockets. As more money goes into farmers' pockets, putting on my best John Hutchinson hat here, going through all these things. But if I'm a farmer and I have more money in my pocket, I'm assuming that that's going to lead to more fertilizer sales, more equipment purchases, more big equipment purchases. So that would be like John Deere, Corteva, fertilizer being CF Industries, some of those. There may be others in that space. Again, I'm not the strongest commodity trader, but I think farmers, I think more money will flow into farmers' pockets. We also have sugar. So domestic sugar is there's quite a bit of a support for domestic sugar, and then also squeezing out import for sugars. So American sugar refining should do well. But any company that imports a lot of sugar would be hurt because they're expecting to jack up prices on imported sugar. So a ticker I'm not familiar with, but I was trying to come up with at least a ticker for everybody. But ASR kind of came through up in my research. as the largest refiner and marketer of cane sugar, but they, they do some of the brands that we're all familiar with. So, and they do have an American presence, so they, should benefit from all of this. And then one of the last ones, this is number 10, dairy farmers get a cushion, so they are expanding coverage for mid-size operations and giving out safety nets. If you make 6 million pounds of milk, I can't even begin to imagine what that is like. That's so much milk. Anyway, that should be good for producers, but not necessarily good for those plant-based milk crowds. So, again, we kind of see this return to, away from, whether it's green energy or, I don't know, I don't want to say like healthy stuff, but we're going back to, where we were in the 50s, what worked in the 50s. That's what we want to go back to. So, or maybe the 80s. Either way, that's, what we're returning to. So that brings us to the 10. Here are those 10 sort of major policy shifts that I'm anticipating to see over the next, 2 to 3 years take place. All right, so we're going to move on to the equity risk premium. And this kind of came up over the last couple of days. It's something that John and I talk about often. So we wanted to share it with everybody. But the term equity risk premium is a very fancy term. It doesn't really matter. But what we're really talking about is the extra return that you would expect by investing in stocks versus risk-free government bonds. And so normally, if you're investing in stocks, you're taking on volatility risk. And so as you're taking on volatility risk, we certainly saw this in April when the stock market had a 20% dip. Yes, it's had a V-shaped recovery, but you're taking on risk by owning these stocks. But the question is, are you getting compensated for that risk? And right now, that premium that you're getting, that additional premium for taking on risk, is actually nearly zero. And the way that we figure that out, this is where the math comes in, is if the S&P 500 PE ratio is about 23, and yes, it's anticipated to move lower. I think the latest I saw was 22.79 or something like that, and then maybe 22.64. But either way, if we take the PE ratio of about 23, that's price over earnings. Well, the inverse of price over earnings is actually your earnings yield. So if we take 1 divided by 23, then that's roughly 4.35. Well, a 10-year treasury yield right now is also 4.35%. So if you are owning stocks in your portfolio, not options, this isn't trading, this is like, I'm talking about long-term investing. If you're owning stocks in your portfolio, and the S&P 500 is right now giving you about a 4.35% earnings return, you're actually not making that much more than a 10-year treasury yield. So it's just something to watch out for. This doesn't mean go ahead and sell all your stocks or anything like that. It's just purely a warning sign. This is just one metric that we use to show that valuations have been stretched. John has been talking about this for a number of sessions that he has done. Talking about forward PE ratios for the S&P 500, saying that the equity premium is stretched. So all this is saying is that right now, and it certainly does not mean that you can't own stocks, and those stocks might go and have a 20% return, 30% return, whatever the case is. I'm just saying right now, overall, broad strokes, the S&P 500 is not exactly paying us for the risk that we're taking by owning stocks outright. And when this has happened in the past, it doesn't happen that often, but when it happens, or when it has happened in the past, the next 12 months for stocks tend to be weak. Now, it doesn't mean that it can't have a positive return. We can maybe still have a 6% return, a 5% return this year, next year, whatever. It just means that it tends to be a little bit weak. That means the trend, the overall macro trends are slowing down. Now, this can be counterbalanced with things, decisions from the Fed. It can be there's other economic growth policy shifts that can happen. So this isn't to scare anyone or anything else. This is just purely a warning sign, especially if you have a lot of stocks in your long-term portfolio. So what can you do during situations like this? Well, there's a couple of different things. There's quality dividend stocks, low volatility ETFs. So SCHD, SCHD, VIG, SPLV. Those are like VIG is the Vanguard. What is it? Had it all in the presentation building up to this, and now I can't remember any. The Vanguard Dividend Fund. So there are some things that again, long term, you might want to talk to your financial advisor. I'm just an educator, so I can't tell you advice, but you may want to lower some of your exposure to as many stocks as you may have in your long-term portfolio. The other thing that you can do, though, which I think is why it matches so much with Traders Reserve and what we do, is there's an option, right? What you can do when stocks aren't giving you a return is turn to options. Now, we don't do a lot of selling covered calls here, but we do a lot of cash secured puts, and cash secured puts is one of the ones, one of the key strategies. You can also put in selling bull put spreads in that as well. But that is one of the things that typically institutions will do when buy and hold equity exposure is weak. And you can also add to that iron condors and short strangles. So again, I think that really matches with what we do at Traders Reserve, and why I thought that was really important to bring up today.
Let's can you roll back to the math slide on the on ERP? Okay, so let's hold here for just a second, and I think I can annotate on your slide. So let's do this. So this PE ratio, highlighting in that lovely purple color, that is the 2025 earnings. So that is this year's earnings expectations yielding 23 PE. But if we take current expectations for next year, for 2026, are running at about 295 to 300. Those are the full year earnings expectations right now for 2026. I'll just notate 26 like that. All right. So if we then take the market currently running at 62, we'll call it 62.85, which I think is about where the ES is right now. What we get is about a 21.3 forward PE ratio. It takes extreme skill to write with a mouse.
With the mouse,
just so you
I know. I'm just saying, I'm quite impressed.
And then if we then do a 1 to get the inverse yield, that gives us an equity risk premium of roughly 4.7%. Right? So compare that with this. And the challenge that you have in the market right now is that spread is too narrow between this year and next. So and treasury yields, I believe, running, I don't know, was it 4.2? Is it still 4.2?
It's oscillating, but yeah.
10-year yield, we'll do a quick Google search. 4.0, looks like it's opening at 4.4.
Yes. So well, that's where the 4.35.
Yep. So now you are upside down if you're a stock owner versus a bond owner. So this is where bonds can lead stocks lower, because the value in owning bonds is greater and safer than the value of owning stocks. So what this little metric is telling you is when it's a better time to own stocks versus bonds. We should always have some bonds in a portfolio. Obviously, 10-year yield, safest investment on the planet, etc. But when this spread is this narrow, covering what would essentially be an 18-month period of time, right, from now until the end of next year, that spread is too narrow, from 4.3 to 4.7%. So don't be surprised, especially if earnings, starting this week, we have banks, financial, and major investment companies. So I think Goldman Sachs, Morgan Stanley, Citi, um, Wells Fargo, et cetera, all start earnings season off at the end of this week. So as we get into earnings season, we need to see earnings beating what are, again, lowered expectations, right? Everybody lowered expectations in Q1. So here we are with Q2 earnings being reported. We need to see those lowered expectations being with beats, not meets. So that, to me, that's going to define the market through the remainder of July and into August. Are our companies largely beating those lowered expectations, not just meeting them? Because meeting them, to me, suggests a greater slowdown than we're actually seeing in the data in the general economy, if you're looking across a broad swath of stocks. But this is a really good exercise to do once in a while, especially when valuations are as high as they are at present time. But the reason that you've had this blow off rally in the last 2 weeks is because Wall Street has switched to looking at 2026 valuations versus 2025 valuations for the full year S&P 500. So they are now using new numbers, and this is I want to say this is somewhere around 10%. It was somewhere between 7 and 10% earnings growth. That's a 7. From 2025 to 2026. So this year is running at 265 and 265 to 270, and they're upping next year's target to that 295 to 300 range. So if anything changes in the July or October earnings periods to negatively impact this year's and next year's earnings expectations, that's where we have that top of market risk. So anyway, wanted to do the math in the background, looking ahead to next year with you, Jeff, because that spread is, to me, that spread is too narrow. That spread needs to be greater than 1%, and it's currently at less than 0.5%. So it's too small, too narrow.
Right. Well, that's good. So that's why we sell cash secured puts and other things with options. Taking that part of the portfolio and a little bit less buy and hold stock part of the portfolio. So just looking at the economic calendar for the rest of the week, it is midweek. So today is the 9th, right? So we do have FOMC meeting minutes at 2 o'clock. Again, I am not a day trader. I've tried that before. I get really bored looking at a screen, and then I start making bad decisions when I sit there and look at 1-minute charts. So I don't do that much day trading, but I mean, for those who know me, I do 90-day, Microsoft options. So I don't get too involved in 2 o'clock FOMC meeting minutes, but it is something to watch out for, especially if you are into zero DTE trades. And then tomorrow we have unemployment claims, and then but overall it's been funny. It's a light economic calendar week, but that has been made up with all sorts of tariff announcements and everything else, which is kind of a bummer that we're getting back into tariff discussions and everything else. I was kind of hoping that was going to be over or just not in the news as much, but here we are.
Here we are.
Yeah, here we are. And that is
all right,
really,
I've got something. I have something to share real quick. So if you want to drop your screen, this is just more of a program note for everybody. Let's see here. I'll put this link in the chat box in just a second, and I'll show you an example of this as well. But if you want more detail about what's taking place in sessions, whether it's Breakfast Club, Income Masters, Millionaires Trading Club, a reminder that you can get our end of day updates. You can also get daily, we call them daily broadcast recaps and highlights. So what did we talk about across our different trading programs or in Breakfast Club? You can also choose to get reminders when we're holding a Breakfast Club or any of our trading sessions for channel updates. So I'll put this link in if you're, excuse me, if you're not getting this. This is what it looks like. We have this first week was which one do I want? I want the one from Monday, right? I want that one. So, right. So this is my full screen for a second, but you can see this was covering everything we talked about during Breakfast Club on Monday, what we talked about or traded or scans, etc. So this is where you can mine for stock ideas, trading ideas, things of that nature. And in the, where are you here? Here we are. So just need to drop your email address in there. Choose which of the reminders you want. The daily broadcast is sent Monday through Friday, so you are up to date at the end of the day, each day on what transpired here on Traders Reserve Live. So if you can't make everything live that day, you don't miss out. And then our Breakfast Club reminders, especially as we start rolling out a near daily schedule over the next several weeks. That'll keep you apprised as to when we're starting each week. Right now, Mondays and Wednesdays, and we'll be adding in some more days as we go through the month of July. So I'll put this this little link here in the chat box. So if you aren't getting those, you can. And I think that'll do it. Look at that. We pretty much, let's see, hang on a second. Back to the right page. And Linda says, I really like the email reminders and the daily recap email. So this has Linda's seal of approval, which means you need to be getting it too. So there's the link. There's no marketing. There's nothing for sale in these emails. This is literally, what did we talk about today? What did we trade today? We don't give out the actual trade details, obviously, because those are for people who are paying for the services. But you do have a way to build a very broad base of stock tickers that you can use as a watch list or as trade ideas, or as investing ideas. Even many of these will have longer term applicability as for you as investors. So grab that, and we will be back next Monday. We have Millionaires Trading Club at 11 a.m. today, and Income Masters at 12:30. So we will see everybody in their live trading sessions. And Jeff and I will be back next Monday at 8:30 with our next installment of Breakfast Club. Jeff, feel free to sign off and say goodbye.
Yeah, just wanted to say thank you, everyone. As we're getting, familiar with what we're doing for Breakfast Club, this is going to continue to shift and evolve and everything else. We're not going to always talk about big macro events. We'll give out trade ideas, and we'll look at scans, and we'll look at some other math type things based on some back tests that I've done. So we'll continue to evolve. So I just wanted to say thanks for being here with us every Monday.
Okay. Thanks, Chet. Thanks, Andrew and Linda. Everybody else, have a great day, and we will see you, some of you at 11 a.m. and others of you at 12:30. Thanks again, and have a great week.